This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This is page 42, Ivana Guido. This is where the valuation is $1.65 each. The non-controlling interest has 32,000 shares, 40% of the 80,000 share capital. Just be very careful because these may be 50-cent shares. They may not have a face value of $1. They have maybe an overall total of $80,000. But if they only have a face value of 50 cents each, then it means there are 160,000 shares, and the non-controlling interest would have 40% of 160. These are $1 shares. Most of the time they will be $1 shares, but just be very careful, because sometimes they're not. Sometimes they only have a face value of 50 cents. We've got 32,000 shares at $1.65. That comes out at 52,800. So the value of the company is 152,008. And we know already from the earlier example that the net assets of the company are 120. So goodwill is 3280. And then the rest is, as per the previous example, example 7, that's the retained earnings are the same. There's no goodwill impairment. So it's just the same as the previous working 7 example, not working, example 7 example. The NCI changes a little bit because the value at date of acquisition is now different. It's now 52,008. The share of post-ac is the same, 28,000. So the NCI is 80,800, and there's no goodwill impairment. In this example 8 and in example 7, there's no goodwill impairment. Which then leads me on to the statement of financial position. With balance sheet totals of 282,800. Okay, I'm going to go back up the screen, back to working 2. I won't erase this, I'll leave it on, so if you want to come back to it, we can do. I'm going to go back up to working 2, where we calculated the goodwill of 32,800. Down the bottom of page 42. Down the bottom of 42, we have this further complication when goodwill is to be impaired. It's not a major complication. It's not mind-blowingly difficult. We know that the figure for goodwill is 32,008. We now got 32,800. Can you read that? Yeah. And we now need to impair it. By 10%, that's 3280. So goodwill on the balance sheet is now going to be 29,520. That's the goodwill on the balance sheet. But that goodwill impairment needs to be split between us and the NCI. Our share of 3280 is 60%. The NCI is 40%. And 60% of 3280 is 1968. And 40% is 1312. That's the share of the goodwill impairment. That's a 60-40 basis. Is anyone not happy with where I've got those figures? 60% of 3280 is 1968, and 40% is 1312. Okay, this affects now our working three. So goodwill on the balance sheet is 29,520. Working three, consolidated retained earnings. I'm starting here with a figure of 132, calculated in the normal way, 132. I need to deduct from that our share of the impairment. So less goodwill impaired since acquisition, and that's 1968. So the consolidated retained earnings is 130,032. It also affects working for the NCI, because their goodwill impairment is 1312, this figure at the top here. Their goodwill impairment is 1312. So if I come down into working for, I'm starting off with 80,800. And they're going to have 1312 deducted from them. So the NCI on the statement of financial position following this impairment is now 79,488. So calculate the goodwill as normal, then calculate the impairment, allocate the impairment according to shareholdings. 60% is mine and 40% is the NCI. My share of the goodwill impairment comes off the consolidated retained earnings. The NCI share of the impairment comes off their entitlement in working for. And this gives me revised figures. I need to go back up here, 29,520. This is a fall of 3,280. Other net assets doesn't change, so 279,520. So we've got a decrease here of 3,280 within the assets. And if you think about it, I've decreased retained earnings by 1968, and I've decreased the NCI by 1312. So there is the corresponding reduction. Goodwill has gone down by 3,280. Retained earnings has gone down by our share of that 3,280, and the NCI has gone down by their share. So the balance sheet now looks like 70,000 share capital, 130,032, and the NCI 79,488, and that should balance 279,520. All right, well, I've done that exercise on page 42. It says this amount, right at the bottom, this amount is allocated on the basis of shareholdings. So you could actually recalculate working 2, 3, and 4 for the other Yvonne Guido examples. Or you could alternatively do mini exercises, page 196. But I want to move on because I don't want to take all your pleasure away from you tonight. I want you to have something left to enjoy this evening so you can impair the goodwill for Yvonne and Guido this evening. So we're on now page 44. If I'm going too fast for any of you, either slow me down, or if you feel embarrassed because you think maybe you're the slowest one and you're holding everybody else back, Don't be embarrassed, ask me, and I'll come and sit with you and I'll go through step by step with you again as often as necessary. Do you know my ambition in life? My ambition is to get rid of you lot out of my life. Some of you can understand this. I just want you out of my life forever. I don't want to see you ever again. And the only way this is going to happen, if I get you through F7, and then I get you through P1, and get you through P2, and then get you through P7. But once that's happened, you've gone. My life is free. I will no longer be burdened by the sight of you people again. Ah, I will be so happy to see you qualified. Not because I won't see you again, you know I'm joking. I'd love to see all of you again. Well, maybe some exceptions. I'm on page 44, other reserves. Exam questions often give us other reserves. The most notable one, the most common one that the examiner will give us is share premium account. The share premium is just another reserve. It's just part of shareholders' funds. And it's treated exactly the same, therefore, as retained earnings, which is also just another reserve. There's a little bit of difference that makes share premium easier, and that is that the share premium account arises because shares have been issued by the subsidiary. Shares have been issued by the subsidiary. And it's only on the issue of shares that share premium account arises. It's only because the subsidiary has issued shares that the share premium account has occurred. It's where shares are issued for greater than their fair value, greater than their face value. So if they're $1 shares and the subsidiary issues them for $1.20, if we have 100 $1 shares, and they're issued at $1.20 each, then the double entry is going to be debit cash, $120, credit share capital, 100 at $1, the face value, and credit share premium, 100 at $1.20 minus $1. So that will be the double entry. So share premium only occurs on the issue of shares. This is where it comes from. It arises because shares have been issued. Those of you who are young mothers face the prospect that as your children grow up, they will be saying to you, "Mummy, where does share premium account come from?" And you should be honest with them and tell them, "Child, it arises because of an issue of shares at an amount greater than their face value." Be honest. It's just a fact of life. So that's where it happens. That's how it happens. And in F7, the share premium account will not have changed since acquisition date. It will not have changed. There will not be any new shares issued by the subsidiary since we acquired. Might happen in P2, but not in F7. Very rarely. I can't remember the last time it happened in P2. So share premium account won't change. If you were to do a working 3 equivalent for share premium, working 3 is normally consolidated retained earnings, but that's just another reserve. If instead of consolidated retained earnings I'd put share premium, then it's the same calculation, Guido and Ivona, per the question, less the pre-acquisition, and in the share premium case, this pre-acquisition share premium will be the same as per the question. It will not have changed subsequent to acquisition. So there will be no post-acquisition movement in the share premium account. But if there were a different reserve, like a general reserve, if we had instead of share premium, we had a general reserve, then there may be a post-acquisition movement, in which case it's still the same working. Therefore, post-acquisition, our share, it's exactly the same working as if it were the retained earnings calculation. The general reserve consolidated is H's own plus H's share of S post-ac. Goodwill will be written off the retained earnings, but otherwise it's the same calculation, H's own plus H's share of S post-acquisition. There's absolutely nothing to be frightened of in terms of additional reserves within the subsidiary. They're just treated all the same, H's own and H's share of S post-ac. We do have another problem, and that's a third of the way down, page 44, mid-year acquisitions. If I were to do a timeline, that's 31st December 2009. That's 31st December 2010. The chances of us acquiring this subsidiary on the 1st of January or 31st December, effectively the same date, the chances of that happening in practice are really quite remote. And the odds against it are 364 to 1 against. And that in fact we will acquire partway through the year. Now your examiner is very kind in this respect because he always gets you to acquire the subsidiary on the last day of a month or the first day of a month. It's always a nice even number of months. Okay, the months are not of equal length. It doesn't matter. The fact that February's got 28 days and December's got 31 days, it's not a problem. Here's an interesting question for you. Which is the longest month in the year? Well, actually it is. There's only one month which is the longest. No, not September, because it's got 9 letters. No. No. It's October. It has an extra hour. October is 31 days and 1 hour. Did you never know that? Do you not? What do you talk about at dinner parties? Do you not talk about that sort of thing? No? Oh, oh yeah, October's the longest month in the year. How did I get there? Oh, yeah. So it's likely that we will buy, for instance, on the 1st of March 2010, we'll buy on the first day or the last day of a month. And we have to presume, unless otherwise stated, sometimes the question will indicate otherwise, but unless otherwise indicated, profits will be deemed to accrue evenly through the year. So when I'm trying to work out what retained earnings were at date of acquisition, it's going to be shares, and then the profits at that date. Now, a common mistake that students make is that there's how many months is this and how many months post-acquisition. This is pre, this is post. How many months pre, how many months post? Vita? How many months pre-acquisition, how many months post-acquisition? 2 pre and 10 post. Do it on your fingers. March, 3 months pre. No, do it on your fingers. January, February. Oh, then it's the 1st of March. It's only 2 months pre-acquisition. It's easy to say 3, and I think 1 or 2 of you did say 3, didn't you? Yeah? Do it on your fingers. And then having calculated January, February, 2 months, then to make sure, and I'm serious about this, to make sure you've not made a silly mistake, you then say March, April, May, June, July, August, September, October, November, December. That's 10 months. So do it on your fingers, because if you make a mistake in the first period and count it as 3, you'll automatically put 9 down for the post-acquisition and you won't have given yourself the opportunity of internal check. It's an internal check to make sure that you've counted the months correctly. So do it on your fingers. You will, half of you, at least once, will get this wrong over the next day and a half. I promise. At least half of you. Because students always do. So we've got the shares, and then we've got the pre-acquisition. We've got the retained earnings, I should say. The retained earnings at date of acquisition. And what students will often do is they'll say 2/12. Let's say this figure is 80,000. And I'll make this figure easy. We'll say it's 12,000 for the year. So 2,000 is there and 10,000 is there. What students will often do is they'll say, up to the date of acquisition, it's 2/12 of 92,000. And they'll take the total retained earnings figure. This 10 plus the 2 plus the 80. They'll take the retained earnings figure from the question, which is 92,000. The question will give us 92, and students will take 2/12 of 92. And of course that's wrong, because the whole of that 80,000 is pre-acquisition, and the only time that time apportionment is applicable is for this year, this current year. 12,000, 2/12 of 12,000 is 2,000, so it's the whole of 80 plus 2,000 of the time apportioned this year. So what I always tend to do is say brought forward 80,000 and 2/12 of this year, 2,000. And I find that that's a safer way of doing it. But that gets me a reasonably close approximation. It's not going to be exactly 2,000, but it's close enough. And it's certainly close enough, I believe, in practice, to assume that profits are evenly spread unless otherwise stated. The other thing you need to watch out for, and it particularly applies to this area of the world, both your neighbours above and below you have the same problem, and that is that year ends are not always going to be 31st December. They won't always be 31st December. Just because it's the calendar year end doesn't make it the accounting year end. In fact, I will go so far as to gamble and to bet that in the exam that you're going to face in less than 9 weeks' time, is it only 9 weeks? The exam that you're going to be doing in less than 9 weeks' time, I'm almost prepared to put money on the prospect, the probability that the year ends that he gives you are not the 31st December. Most likely it will be 30th of September, but it could be any date through the year. It won't normally be part way through a month, it'll be a month end. But I had a client, those of you may have heard me say this before, I had a client who had a year end of the 14th of October. He came knocking on my door on the evening of the 14th. Brian, what are you doing here? He said, I brought my paperwork for my first year. I said, but it's only the 14th of October. He said, yeah, but I started my business on the 15th of October last year, so the 14th of October is my year end. So from then on we did his accounts based on the 14th of October year end. It can be any date throughout the year. Here, traditionally, it's 31st December. In the exam, traditionally, it's not. So be very, very careful about year ends. This problem arises because we're having to work out what are net assets at the date of acquisition. The share capital is not a problem, that's no question. Retained earnings brought forward is not a problem. Retained earnings brought forward, retained earnings for 2 months this year. There may be a share premium in there as well. There may be a share premium account. There may be a revaluation reserve. There may be a general reserve. There may be all sorts of different elements of shareholders' funds. But shareholders' funds equals net assets. And what we're trying to do is find the value, the fair value of the net assets at date of acquisition. Do you see a problem there? No problem. No problem.